Refinancing your student loans involves taking out a new loan to pay off your existing educational debt. Like the consolidation process for federal loans, refinancing can combine your existing loans into one simple monthly payment, potentially at a lower interest rate or with more advantageous terms. After evaluating whether this process is right for you, you can check your credit and shop for the best rates. Taking these steps can help you figure out what lenders you might qualify for and find the best deal for your unique financial situation. If approved for a loan with a lower rate, you could save thousands of dollars on interest. Number 1. Check your credit. When you apply to refinance your student loans, one of the first steps a lender will take is checking at least one of your credit reports and credit scores. This is why you should review your reports from Equifax, TransUnion, and Experian regularly to check for any mistakes or errors. If you discover inaccurate information on a credit report, the Fair Credit Reporting Act, FCRA, gives you the right to dispute those items with the appropriate credit reporting agency. It's also wise to get an understanding of where your credit currently stands before filling out loan applications. You typically need to have a good credit score, usually defined as a FICO score 670 or higher, to qualify for student loan refinancing without a cosigner. If you find that your credit isn't in the best shape, you can work to improve your credit before you try to refinance. As a result of the COVID pandemic, you can view your credit reports from the 3 major credit agencies Experian, Equifax, and TransUnion for free weekly through December 2023 by visiting annualcreditreport.com. Number 2. Shop for the best rate. Researching student loan refinancing rates and checking with multiple lenders to find the best rate is a key element in successfully refinancing your student loans. Rate shopping should be something you do anytime you're looking for a new loan or credit card. In general, the higher your rate, the higher your monthly payments. On the flip side, qualifying for a loan at a lower rate can lower your monthly payments. Search online to compare lenders' rates and fees. If a lender offers a pre-qualification tool, take advantage. These applications require only a soft credit inquiry on your credit report. Getting pre-qualified can help you see the rates and loan terms you might qualify for if you refinanced. You can use this information to see if refinancing would leave you any better off in terms of your monthly payment or total interest paid. Number 3. Choose a loan offer. Once you've reviewed and hopefully pre-qualified for several loan offers, you'll be better equipped to choose the option that suits you best. The lender you choose to work with may let you select your preferred repayment terms as well. A shorter loan term, 5 years, might help you secure a lower interest rate and pay off your debt faster. However, your monthly payment would likely be higher. If you extend the loan term, on the other hand, you could reduce the size of your monthly payments and make managing your budget easier. The trade-off would be more interest paid over the life of the loan and more time passing before you eliminate the debt. 4. Fill out an official loan application. Once you've narrowed down your preferred lender and loan offer, you must complete an official loan application. Even if you went through a lender's pre-qualification process, you must complete this step before your loan can be approved. At this point, the lender will likely run a hard credit inquiry to access your full credit report. The lender will also want additional information you didn't include on your pre-qualification form. If you're applying with a cosigner, you'll need to provide their information as well. You may need to provide the lender with copies of documents and information such as Social Security number, SSN, driver's license or government ID, loan payoff statements from existing student loan lenders or services, proof of graduation, proof of employment, pay stubs, W-2, etc. Number 5. Sign your loan documents and start paying your new loan. Once approved for your loan, you'll sign your loan documents. Technology has made this step considerably easier. Where you once had to sign loan documents in person or fax or mail them in, most student loan companies now handle their entire process online for ultimate convenience. Once your documents are signed and filed, you will begin making payments on your new loan just like you were with your old one. However, your new lender may not pay off your former loans right away. Sometimes the process can take a few weeks. Continue making any student loan payments that come due in the meantime so you don't face late fees or potentially negative credit reporting. Should I refinance my student loan? Refinancing a student loan could help you get out of debt sooner and possibly reduce your monthly payment obligations, but this hinges on whether you qualify for a good deal. Before you decide to refinance your student loan, there are a few factors to consider. Type of loan. The type of loan you have may impact your options for refinancing. Refinancing can only be done through private lenders, so refinancing your federal loans means losing federal protections like federal forbearance, income-driven repayment plans, and more. Remaining time left. Refinancing into a longer repayment period could increase the overall amount of interest you'll pay on your loan. If it is almost paid off, it could be cheaper to stick with the loan you already have. If you're at the start of your repayment period, on the other hand, refinancing may not impact you as much. Current interest rate. Most people refinance to get a lower interest rate. Getting a lower rate means you could pay less interest over the loan term if you don't stretch out your repayment term. Monthly payment. Refinancing is a good idea if you have an unmanageable monthly payment. Extending your repayment term may ultimately increase the interest you pay, but it will also lower your monthly bill. When in doubt, use a student loan calculator to compare your current loan with any new loans you're considering. You may stand to save money over the term of your loan, or even shorten your repayment period altogether by refinancing. This process is done through private lenders, so if you need or benefit from some of the perks of federal loans, you will need to weigh the pros and cons. Ultimately, a refinance can simplify your repayment and, depending on your credit, lower your monthly payments. Before securing a refinanced loan, be sure to shop around for the best rate and terms.